I would love to introduce our speakers today that are going to take you to the journey about open finance today. So the speakers are Justin Bons, who is a founder and CIO of Cyber Capital. Welcome, Justin. Geert Jochems, who is CFO of Cyber Capital. It's Luc Weber, Research Investment Associate of Cyber Capital. It's also Thomas Franken, who is investment manager, and he's also going to moderate further on the current webinar. It's myself, you already know me, and it's Zeb Demian, who is research associate. So very much looking forward to hear all the speakers out. Digital assets remain a very challenging topic for accountants and also for reporting professionals worldwide. It is so far a little bit underexplored area, and it triggers several key challenges for any organization that would like to adopt the digital assets. So, for example, you see the key challenges on the left side of the slide. Recognition of the assets from accounting perspective. So, how do you recognize in your books? Measurement, valuation of the asset. Is your valuation accurate? And also definitely impact on internal control environment. This is all also has relation to an overarching topic of regulatory compliance and
there is already regulations applicable in the digital world. So if one would think that it would be unregulated world, that's not true. The regulators are really looking close to this new world. And they already set pretty clear beacons in the past, say, year, 1.5 years. If we continue to the next slide, the first beacons to be set out is that you have to make a definition. What are qualifications of the different digital assets? And well, you saw that from Vera's presentation. From accounting perspectives, you have different classifications, but the regulators in the financial world have set some beacons as well. And that could be either a financial instrument, it could be e-money, or, and that's the most obvious one, no qualification yet. But still, on the first hand, it seems like sailing in the mist. But if you look a little bit further, you see that there are clear beacons there. And it's only now up to the investor or to the user of digital assets. Do you sail at random with all the risk there? Or are you using the beacons? Well, we at Cyber Capital are very clear. We are part of the beacons. Thank you very much.
Let me give you an example. So, like, if a company would like to use digital assets, then this means that several things would need to be revised or to change in the organization. So, for example, compliance and accounting framework has to be at least reevaluated to a certain extent. It depends on what is your strategy, but it can be a significant change, but it can also be not a very significant change, but it has to happen. Then you need to understand how do you want to recognize digital assets in your books. For example, as intangible assets, as commodity, for trading, for example. And you would like to embed your findings in internal policies. Further, you need to understand, or the organization needs to understand, how to store digital assets. Yes, how do you account for it? I have already mentioned, so it's valuation, and also how do you keep up with all the compliance requirements?
So first of all, the first thing that's important to understand about cryptocurrency is that it's decentralized. It's a distributed network. That means there's no central points of control or failure. So this might be familiar to you in the form of peer-to-peer file sharing networks, which do have this characteristic as well of being distributed, where you could say that everyone is in control and no one is in control at the same time. But what this does is it gives it a very special property, which is among one of these properties is actually neutrality. There is no particular attachment in terms of any country or any regulation. And this bridges into concepts of immutability, how history cannot be changed by the victor. It also creates a characteristic where blockchains are censorship resistant, in that because history cannot be rewritten, essentially, history can be put on a blockchain and it will be there forever. So this is very much at the core of why cryptocurrency matters. is that what it achieves is trust without centralized authorities. And it's important to keep in mind that currency is just the first application of this technology. This can be extended to many different applications. And what this effectively means is the removal of middlemen. And this is where this technology creates economic efficiencies. It creates tangible economic benefits for users and businesses. Is where if there is change, it requires some form of governance. And this is where we get into decentralized governance. How do we govern a protocol without a center? This is an area I tend to specialize in more. But what a blockchain effectively does is it has, in other words, compliance and regulation built in. It's built into the system in that you cannot double spend, or you cannot commit fraud, you cannot spend your coins twice, right, is an example of this. And the fundamental aspect of that is that today billions are being spent on fraud prevention. And this is also where blockchain technology also provides a very high degree of security for everyone, from institutions to individuals. And the idea behind this is within these 3 layers, we're able to evaluate them differently because they're actually very different in understanding and what they actually are. So we've started with a blockchain, right? That's the key element. That's the aspect that provides security, that provides the transparency, that provides the platform for many other applications to be built on top of. And what we've seen is that on top of the base layer, we have what we refer to as the network layer. And this is applications that are used by other applications that are built on top of, in this example, Ethereum, right? And on top of that, we have the application layers. Now, the example of this is that what ends up occurring is that in order for an application to function over the Ethereum network, it needs to pay a fee. Okay, and what we see happening is that the fee ends up moving down the network in this way.
So before diving into open finance, it's important to explain one concept. That's the concept of composability, which is the ability to select and assemble various components to satisfy specific user requirements. So what this allows you to do is to pick and match different functions to create your own complex or simple financial services. In the industry, they refer to these building blocks as money Legos because you can basically stack them on top of each other. Anybody who has played with Legos before knows that if you want to build a nice building, but the same goes for building a financial ecosystem, you need a very strong foundation. And in our example, that foundation is the protocol layer, as Justin already explained before. It's oftentimes Ethereum, the second largest and arguably the most secure programmable blockchain. So we have this open and secure foundation, the base. But what can we do on top of it? You can even gain exposure to different assets that are not per se on-chain. So for example, in the derivative example, the Bitcoins and Ethereum already live on a blockchain, but that limits your ability to create financial assets. But with synthetic assets, you have the opportunity to recreate price packs that allow you to trade almost any asset that you can think of. So different assets that you could do is, for example, currencies like the yen or the dollar, but also gold, stocks, bonds, commodities, or even new open finance assets, which I think are maybe even more interesting. Think of tokenized pieces of the Mona Lisa. You can trade a piece of the Mona Lisa, or at least the price of a piece of the Mona Lisa, through these synthetic assets using these decentralized exchanges, or even decentralized autonomous organizations. You can own a piece of a revenue-generating digital organization without needing to interact with any central entity. I just want to give you the main takeaways. First of all, cryptocurrencies and crypto assets enable trust without centralized authority. And open finance utilizes these functions to recreate or even create new financial services without relying on a central entity. This creates a neutral, free economy on the internet. It can't be stated enough how big this is. Currently, there are a lot of barriers in the so-called it's completely neutral and only the best products will win. And from an investor perspective, this opens up new opportunities as well. And this is not something that can be built. This is something that's already here. Currently, you can already do lending, exchange, stable coins, but also insurance and prediction markets, and it's only growing from here.
So I described it for as a commodity currency, and I think in that sense, cryptocurrency is what we can refer to as a monetary revolution, in the truest sense, because the word revolution comes from to revolve. So what we're doing with cryptocurrency is it is essentially the digital equivalent of the precious metal coins of the past, right? Because precious metal coins in the past were used as a currency, and they were used as a commodity. They were a store of value, and they had utility as a medium of exchange. Okay, so this is very different to how our currencies operate today, and this is actually a more recent development in terms of you know, how private central banks, for the most part, create money, loan it to governments, and we have this type of fiat, you know, by authority money, which is also different to how precious metal coins worked to an extent. So this is really a revolution in that sense. What I think cryptocurrency does is it brings about more economic freedom, removing barriers to entry, reducing friction between borders, and this brings about more economic prosperity due to there being more economic freedom. And due to barriers and not being able to be set up in cryptocurrency in the same way, and we don't have issues of regulatory capture, I would argue this would lead to less wealth inequality, as equal opportunity essentially is raised as a macro effect. Now, cryptocurrency also brings transparency. So institutions can have an extremely high degree of transparency where their books can be publicly audited or selectively audited by third parties, where fraud is essentially impossible due to the cryptographic nature of this and the incentive nature, because we could set up cryptographic systems before, right? But anyone who controls the service can change whatever they want. And this is no longer the case with a system like this.